This is dollar logic, where we break down the hidden logic behind money, business, and the systems that shape your everyday life. No jargon, no fluff, just clear answers. There is a three-digit number attached to your name that you didn't choose, can't see by default, and probably never agreed to. It decides whether you get an apartment, how much you pay for a car, and sometimes whether a company will even talk to you. It's your credit score, and most people only find out how it works after it has already cost them money. So let's start with what it actually is. A credit score is a prediction. It estimates how likely you are to pay back borrowed money on time. That's it. It is not a measure of how rich you are, how responsible you are as a person, or how much you earn. Lenders don't know you, they know your history with debt. The score is a shortcut for that history. Most scores in the United States run from 300 to 850. Higher means lower predicted risk. Roughly speaking, anything above 740 is treated as very good, the mid-600s as fair, and below 600 as high risk. But there isn't one single score. There are several scoring models and three major credit bureaus, each holding slightly different data. So the number your banking app shows you may not be the exact number a lender sees. The overall picture is usually similar. Now what actually moves the number? The biggest factor by far is payment history. In the most common model, about 35% of the score. Did you pay what you owed on time? One payment 30 days late can do real damage. And a late payment can stay on your credit report for about 7 years. Second is how much of your available credit you're using. That's called credit utilization, and it's roughly 30% of the score. If your card limit is $1,000 and your balance is $900, your utilization is 90%. Lenders read that as strain. A common guideline is to keep utilization under 30%, and lower is generally better. Third is the length of your credit history, around 15%. Older accounts help. This is why starting early quietly matters. Fourth is new credit, about 10%. Every formal application creates a hard inquiry, and several in a short window looks like desperation. Fifth is credit mix, also about 10%, whether you've handled different types of credit, like a card and an installment loan. Now here's what surprises people. Your income is not in your credit score. Neither is your savings balance, your job title, or your debit card use. You can earn well and have a poor score. You can earn little and have an excellent one. The score only tracks borrowing behavior. Which brings us to why this matters years before you'd ever think about a mortgage. Renting an apartment. Many landlords run a credit check, and a weak score can mean rejection, a larger deposit, or a required cosigner. Phone plans and utilities. Providers often check credit before giving you a contract and may ask for a deposit up front if your history is thin or poor. Car insurance. In most U.S. states, insurers use a credit-based insurance score to help set premiums. A few states, including California and Massachusetts, restrict or ban the practice. And employment. Some employers run credit checks for certain roles, usually financial ones. Important detail, they don't see your score. They see a modified credit report, they need your written permission, and several states limit when it's allowed. So the score shows up in ordinary life long before it shows up in a bank. Let's put a number on what it actually costs. Take a $20,000 car loan over 5 years. At a strong credit rate near 7%, you'd pay roughly $400 a month. With a weak score, that same loan might come at 15%, closer to $475 a month. Same car, same 5 years. Around $5,000 more purely because of the number. Scale that up to a mortgage and it gets serious. On a $300,000 loan over 30 years, a gap of 1.5 percentage points is about $300 a month. Over the full term, that's roughly $100,000 for the same house. Rates change constantly, so treat those as illustrations, not quotes. The pattern holds. A low score is a permanent surcharge on borrowing. Now 3 things people believe that aren't true. Myth 1, checking your own score lowers it. It doesn't. Checking your own is a soft inquiry, and soft inquiries have no effect. Only applications create hard inquiries. Myth 2, you need to carry a balance and pay interest to build credit. Also false. What gets reported is that you used the card and paid on time. Paying in full builds history just fine and costs you nothing in interest. Myth 3, closing an old credit card cleans up your profile. Usually it does the opposite. You lose that card's available credit, which raises your utilization, and eventually you lose some of your account history. So what can you actually do, especially if you're starting from nothing? First, never miss a due date. Automatic payments for at least the minimum remove the most damaging mistake from the table. Second, keep balances low relative to your limits. Using a small share of your credit consistently reads better than maxing out and paying it off. Third, be patient with age. Keep your oldest account open even if you barely use it. Fourth, apply for credit rarely and deliberately. Store cards at checkout are the classic way people collect inquiries they didn't need. Fifth, read your own credit reports. In the US, you're entitled to free reports from the major bureaus through the official annual report service. Errors are common, accounts that aren't yours, payments marked late that weren't. You can dispute them and correcting one can move your score. One more thing worth saying clearly. This is how the system works in the United States. Other countries score credit differently, some use simpler registries, some mainly record defaults. The principle travels even when the numbers don't. Institutions track how you handle obligations and they price you accordingly. And that's the real point. A credit score isn't a judgment of your character. It's a record of consistency kept by people who will never meet you. Which also means it's fixable. Slowly, quietly, through boring repetition, and the earlier you start, the less it costs you. That's how it actually works. Understanding money doesn't have to be complicated, it just has to be explained clearly. If this helped, subscribe to Dollar Logic for more videos that make sense of the systems around your money. See you in the next one.